Could we be facing an economic storm? Today, we dive into the side hustle boom happening across America, what it means for our economy and your wallet. We also explore the frightening parallels to past financial crises, the shocking collapse of China's economy, and how gold is becoming a safe haven amidst the chaos.
We'll summarize the top financial insights from expert videos, giving you the knowledge you need in the fastest way possible. Don't forget to like and subscribe to support our channel.
First, Brian Kim talks about the side hustle boom sweeping America. Next, Game of Trades explores similarities between now and past economic crises. We'll also hear Jeff Snyder's alarming take on the collapse of China's economy. John Rubino explains why a recession might be the least of our worries. Venues across Florida see bizarre real estate shifts. Details from MHFIN. Lobo Tiggre explains why gold prices are at an all-time high. Marko Papic breaks down the geopolitics and market impacts of a Trump assassination attempt. And finally, Christopher Mullen updates us on equities, bonds, precious metals, and his own market strategies. Welcome back to ClearValue Tax on YouTube. Today, we are diving deep into a fascinating topic sweeping across America: the side hustle boom. Is it a beacon of entrepreneurial spirit or a sign of tougher economic times? Brian Kim gives us the lowdown.
That's right. With 36% of Americans picking up a side gig, we're not talking about a small trend. It's across all ages, from Gen Z to baby boomers. Let's break it down.
So what's Brian's main point here? Why is side hustling becoming so widespread?
The thesis is clear. The surge in side hustles is due to the rising cost of living and inflation. While it showcases entrepreneurial drive, it also highlights serious economic challenges.
All right, let's hit those key points. How prevalent are these side hustles?
A whopping 36% of Americans have a side hustle. Almost half of Gen Z adults and a solid chunk of millennials, Gen Zers, and even baby boomers are in on it.
Interesting. What about earnings? How much are folks making?
The average earnings are $891 a month, which is up 10% from last year. But it varies. Some make thousands, others less than $50. It's all about the time and type of work you put in.
And the time commitment.
Many side hustlers spend significant hours weekly in addition to their full-time jobs. Most are relatively new to this, with 59% having started within the last 2 years.
What kind of side hustles are we talking about?
Everything from driving for Uber and delivering for DoorDash to freelancing on Fiverr and selling on eBay. Some are aiming to be the next TikTok stars. The variety is huge.
Let's take out the crystal ball for a moment. What predictions did Brian make?
First, the rise in side hustles points to underlying economic stress, which might push policy discussions on wage growth and living costs. Secondly, we could see more folks transitioning from side hustles to full-time self-employment, changing the job market landscape.
So what's the final takeaway?
Brian emphasizes that while side hustles are a sign of American adaptability and creativity, they also reveal deep economic issues like inflation. He advises caution and incremental growth for those considering moving from side hustles to full-time self-employment. Sound advice for navigating these turbulent times.
Hey everyone, welcome back to Game of Trades on YouTube. Today, we're diving into the possibility that we might be reliving the worst financial crises in history. Buckle up.
That's right. Our team at Game of Trades takes us on an analytical journey through current economic indicators and their eerie resemblance to those seen before past recessions. Let's get into it.
So, what's the main argument here? Are we really on the brink of another financial disaster?
It certainly seems possible. The thesis is that the U.S. economy might be heading towards another major downturn, despite the glowing stock market rally. They point out that several key sectors are showing signs of weakness we've only seen before major financial crises.
Let's break down those key indicators. What sectors are sounding the alarm bells?
Well, we've got the banking, consumer discretionary, and home building sectors all showing signs of significant weakening. These sectors have historically been the canaries in the coal mine for broader economic trouble.
So we've seen this movie before.
Absolutely. The last 20 years show 2 instances of similar sector declines, right before the global financial crisis in 2008 and just before the 2020 recession. Déjà vu, right?
Despite these warning signs, the stock market is still soaring. What's going on here?
Exactly. The market's current rally is almost paradoxical given the underlying economic issues. The video questions how sustainable this rally can be when foundational sectors are crumbling.
Sounds like we need to be watching some key metrics.
Definitely. Keep an eye on the unemployment rate and initial jobless claims. History shows us that major market crashes tend to coincide with rising unemployment.
And valuations are through the roof.
Big time. The Shiller P/E ratio, a respected market valuation measure, is showing levels similar to those before the Great Depression and the 1999 dot-com bubble. It's like we're walking a tightrope here.
All right, let's hear those predictions. How bad could it get?
Short term, we might see a small 2 to 3% pullback from weak economic data. Medium term, experts like Morgan Stanley's Mike Wilson are calling for a 10 to 15% decline. Long term, a whopping 60% market pullback could be on the horizon if unemployment spikes.
What about the Fed? Can they save the day?
It's complicated. The Fed might struggle to intervene as inflation remains high, even though interest rates are similar to those in the 1990s, when rate cuts often propped up the market.
So, what's the bottom line?
While short-term dips are likely, a major market correction might only occur if unemployment significantly rises. Until then, the Fed may continue to support the market, but cautious investing is key. Stay alert and keep your eyes on those economic indicators.
Welcome back to Eurodollar University. Buckle up, folks. Today we're tackling China's economic disaster, and boy, is it grim.
Indeed, Jeff Snyder's breakdown offers eye-opening insights into why China's economy is crumbling and what that means for the rest of us.
So, what's the main argument Jeff Snyder is making here?
Jeff argues that China's economy is in free fall, with systemic issues in real estate, rising financial risk aversion, and ineffective government stimuli. The future looks bleak.
Let's deep dive into those key points. What's happening with Chinese loan growth and real estate?
Loan growth is at record lows, showing a dramatic drop in both economic activity and confidence. Meanwhile, home prices are in a free fall, among the worst in modern history.
And how is the government responding?
Xi Jinping is more focused on tightening military and political control rather than fixing economic issues. Essentially, he's holding the nation in a death grip while the economy nosedives.
Scary stuff. So what does this mean for the global economy?
Global monetary systems are tightly intertwined with China's economy. Any major downturn in China has ripple effects worldwide. Yet, despite all the failures, Western experts are still calling for more ineffective stimulus.
All right, time to gaze into Jeff's crystal ball. What does he see coming next?
Jeff predicts that Chinese economic metrics will keep falling with no effective stimulus in sight. Moreover, this collapse will compel Xi Jinping to tighten his grip further, creating complex political dynamics.
And globally,
brace yourselves. This downturn could trigger broader global economic issues. Investors and policymakers better prepare for some serious ripple effects.
So what's the big takeaway?
China's economic misery is a global concern. Jeff highlights the limits of government intervention and stresses the need for better preparation. Forget ineffective stimulus. We need real solutions.
Welcome to Thoughtful Money on YouTube. Today, we're diving into some deep waters. What if a coming recession and bear market are the least of our worries? Our guest, monetary and macro analyst John Rubino, is here to explain why we may be facing much bigger issues.
Absolutely. John Rubino is a seasoned analyst and co-author of The Money Bubble. He really challenges conventional thinking, and folks, buckle up because this is going to be a wild ride.
So, what's the elephant in the room that Rubino is talking about?
His main thesis is that while a recession and a bear market are looming, they're mere distractions from a catastrophic failure of the fiat currency and fractional reserve banking system that began in the 1970s. He sees this failure as being driven by unsustainable debt levels.
That's a bold claim. Let's dissect some of the critical points Rubino makes. What about the near-term outlook?
In the near future, we should expect a downturn featuring declining consumer spending, a slumping housing market, and a bear market for equities. Rubino links this to dwindling excess savings from the pandemic and rising reliance on high-interest credit card debt.
Ouch! And what's happening in the world of commercial real estate?
Commercial real estate is in mini-crisis mode. Office buildings are losing value and being sold at steep losses, which impacts the balance sheets of local and regional banks. It's a domino waiting to topple.
Sounds dire. Now, what about the long-term picture?
Long-term, Rubino says we're facing the collapse of the fiat currency and global military empire experiment. Major economies are buckling under parabolic debt growth.
Yikes! And this debt spiral, what's the kicker there?
It's a vicious cycle. Growing debt leads to higher interest costs, which necessitates more borrowing. It's like using a credit card to pay off another credit card bill. Unsustainable in the long run.
Okay, so John Rubino has outlined the problems. What predictions does he make?
Short term, he sees a recession with inherent drops in consumer spending and an ensuing bear market. Long term, he predicts the ultimate collapse of economic systems built on unsustainable debt, leading to the need for a currency reset.
Any takeaways for our viewers from Rubino's analysis?
He stresses the need for strategic caution and realistic tactics to cope with the looming economic challenges. Rubino emphasizes the importance of being prepared for not just a recession, but a potentially catastrophic systemic failure.
Welcome to MHFIN, everyone. Today, we're unraveling the mystery of Florida's housing market with the video Evidence That Something Bizarre is Happening, Florida Crash Update. It's a deep dive into whether Florida is on the brink of another massive housing crash. Exciting stuff.
Absolutely. This one's got all the drama of a soap opera. Skyrocketing prices, ominous inventory surges, and the potential for a market meltdown. Florida's real estate market is like a thriller novel you can't put down.
Let's get straight to the heart of the matter. What's the core thesis?
In a nutshell, Florida's housing market is in a high-risk bubble that may be about to pop. Rising prices and inventory are red flags suggesting another crash could be imminent, much like the 2007 debacle.
All right, let's dive into the nitty-gritty. Can you lay out the historic price trends for us?
Sure thing. Florida is a wild roller coaster. Miami's home prices surged 217% from 1996 to 2007, only to crash by over 50%. And get this, it took nearly 14 years to bounce back.
Wow, talk about a wild ride. And what's happening in the market right now?
It's kind of a mixed bag. Price cuts are becoming more frequent, and inventory levels are shooting up like fireworks on the 4th of July, sparking concerns that this could be the start of another crash.
Got it. And what's this about income versus home prices?
Nick from Reventure Consulting notes that Florida's homes are 30% overvalued compared to long-term income norms. In Miami-Dade, a typical family spends a whopping 78% of their income on a mortgage, compared to just 25% in Cleveland.
Sounds like a real pickle. But there's another theory, right? The privilege class theory?
Yep, the idea here is that only the wealthiest 10 to 20% can afford homes, often thanks to financial help from parents or selling high-value homes elsewhere. Look at Honolulu. Home prices are sky high but haven't crashed because wealthy buyers dominate the market.
Interesting perspective. So how does inventory and foreclosures play into this?
Inventory spikes in hotspots like Lakeland are causing some to worry. But even with increased listings, prices have remained stable or even risen in areas. Plus, foreclosure rates are really low, unlike the 2007 crash.
So what are the predictions on how this will all shake out?
Well, we might see a temporary slowdown in specific markets, but an all-out crash like 2007 seems unlikely due to homeowners' financial health.
So no need to panic just yet. What's the long-term outlook?
The U.S. may end up like Europe with high housing prices and affordability issues driven by wealthy buyers. Local affordability won't dictate prices as much.
All right, give us the big takeaways.
Florida's market is complex. While red flags suggest a slowdown, a 2007-style crash is unlikely. The gap between incomes and home prices could keep growing, driven by affluent buyers, similar to trends in Europe and Australia.
There you have it, folks. A roller coaster of a housing market. But it looks like we might not be heading for a crash landing anytime soon. Make sure to like and subscribe for more insights from MHFIN. Welcome to Kitco News. Joining us today is the ever-insightful Lobo Tiggre. Why is gold glimmering brighter than ever? Let's unpack that.
Oh, absolutely. Lobo is here to dissect how cooling inflation and looming rate cuts are setting the stage for gold's shiny comeback. Get your nuggets of wisdom ready.
So what's the golden takeaway from Lobo's insights? What's driving this surge in gold prices?
The core thesis is that cooling inflation and anticipated rate cuts are creating the perfect storm for gold. With the economy appearing shaky, gold becomes an attractive refuge for investors seeking stability.
Let's break down those nuggets of wisdom. Starting with the economic conditions Lobo mentioned. What's the forecast?
The consumer price index is cooling, which usually spells economic trouble and hints at rate cuts. But the core inflation rate is still over 3%, signaling ongoing issues.
So how did the markets react to all this? Sounds like a seesaw.
Exactly. With cooling inflation, the Dow shot up to 40,000, and gold hitting $2,400 shows that rate cuts weren't fully priced in yet. It's like the market got a golden ticket.
Interesting. But isn't gold mainly an inflation hedge? What's happening here?
We're in a topsy-turvy economy. Gold is also becoming a hedge against economic instability. Investors globally, including those in China, are gravitating towards gold to safeguard against economic downturns.
Looking ahead, what did Lobo predict for the economy in gold?
He foresees a hard landing for the U.S. economy, possibly by the end of this year. Even with 1 or 2 predicted rate cuts, it's bullish for gold. If the economy worsens, gold could rocket even higher.
All right, time to gaze into the crystal ball. What are Lobo's predictions?
Lobo predicts a significant downturn for the U.S. economy by year's end. And for gold, even if the mainstream forecast of minor rate cuts happens, it still skyrockets. If things get worse, gold could really shine.
To wrap it all up, what are the final golden nuggets from Lobo?
Lobo emphasizes that current economic conditions make gold an essential hedge against instability. With possible rate cuts and a weakening labor market, gold is looking ever more appealing. Keep an eye on these trends and consider gold your safe haven in uncertain times.
Welcome to the David Lin channel on YouTube. Who would have thought that an attempted assassination could swing an election? Well, that's exactly what's on the table today as we discuss the market and political fallout with Marko Papic of BCA Research's GMacro.
Absolutely. Marko dives into how this shocking event could play a crucial role in the upcoming election and market movements. Strap in, folks.
All right, the headline here. How does an attempted assassination alter the election landscape?
Marko argues that such events galvanize voters, especially those on the fence. The aim is clear. Get conservatives and center-right voters off the couch and into the voting booth. The sympathy vote phenomenon is real.
Interesting. So how do historical parallels play into this?
Think Reagan in 1981. His attempt skyrocketed his political status to mythic heights. Marko highlights that Trump's betting odds have climbed to 70%, quite the jump.
Isn't this all about U.S. domestic politics at the end of the day?
Sure is. Marko has consistently viewed Trump as a 60 to 70% probable winner. Even swapping out Biden won't significantly shift Trump's standing. It might just signal Democratic desperation.
And what about on the foreign policy front?
Here's the twist. Trump could lead with a pragmatic, deal-making approach, especially with China and Russia. Less ideology, more, what have you done for me lately?
And on the economic side?
Hold on to your seats. Marko predicts a significant slowdown in U.S. growth over the next 6 to 12 months. But there's a silver lining for long-term investors, especially in commodities and emerging markets.
So what predictions are we looking at?
Firstly, Trump's chances are on the rise, bolstered by increased voter turnout. Secondly, expect a more transactional foreign policy under Trump, maybe even easing tensions with China. Lastly, don't expect oil prices to shoot up drastically if the Ukraine conflict resolves. It's already priced in.
Wrapping it all up, what should we take away from today's discussion?
Marko emphasizes strategic caution. From monitoring geopolitical moves for investment opportunities to anticipating aggressive Fed rate cuts, there's a lot to consider. But the big takeaway? Don't sleep on how these events can reshape the landscape in more ways than one.
Welcome to the Technical Traders on YouTube. Today we've got an exhilarating market update brought to you by Christopher Meelan. We'll be unpacking insights on equities, bonds, precious metals, and his very own positions.
Hold on to your hats, folks. Christopher Meelan is a seasoned trader and investor, and he's got some juicy info to sink our teeth into. From market trends to precious metals, there's a lot to digest.
Let's get to the heart of it. What's the main takeaway from Christopher's update?
The main thesis is that the market, despite some hiccups, remains in an overall rising trend. Christopher emphasizes a strategic approach to portfolio management, focusing on capturing these trends and making informed decisions, especially in equities and precious metals.
Great. Can we break down those key points? What's been happening in market movements?
Absolutely. Despite recent pullbacks in QQQ, we're seeing a sustained rising trend. Short-term indicators like panic selling and overbought signals hint at possible pauses or pullbacks. It's the market's roller coaster ride. Just make sure you hang on tight.
Got it. Now, how are specific sectors performing?
Bonds and utilities took a nosedive recently. Utilities were down 2.5%. Ouch! And precious metals and miners are having a moment, with gold on the cusp of breaking into new highs around $26.50 to $27.50. Shine on, you crazy metal.
What kind of predictions are we looking at here?
First up, the market might face multi-day or multi-week pauses or pullbacks in the short term. As for precious metals, gold and silver are expected to keep rallying, with gold potentially hitting $27.50. And on interest rates, contrary to popular belief, Christopher thinks a Fed rate cut isn't likely without significant market pain. No pain, no rate cut, folks.
Wrapping it up, what are the big takeaways?
Christopher underscores his consistent growth strategy. Steady and low volatility is the name of the game. The key message: don't sweat the fluctuations, stay disciplined, and ride those trends. A long-term approach helps navigate market waves without undue stress. It's all about that consistent upward movement.
In today's video, Brian Kim highlighted how the side hustle boom is a symptom of economic strain.
Game of Trades warned of troubling similarities to past financial crises, while Jeff Snyder painted a bleak picture of China's economic collapse.
John Rubino described an impending systemic failure of fiat currencies, and MHFIN provided a cautiously optimistic view of Florida's real estate spike.
Lobo Tiggre suggested gold's rise as a safe haven amidst economic uncertainties.
Marko explored how geopolitical events like a Trump assassination attempt could influence market dynamics.
And Christopher Mullen emphasized strategic portfolio management in these uncertain times.
The experts agreed we're facing significant economic challenges, highlighting both immediate and long-term risks. However, they diverged on the best strategies for navigating these turbulent times, be it investing in gold, preparing for a financial reset, or cautious optimism in real estate. Thanks for tuning in. Thanks for watching Financial Analysis in Review for July 16th, 2024. If you'd like more time-saving content, please remember to like and subscribe. If you have ideas for more channels you'd like to see summarized, drop a comment below. See you next time.